is Bloomberg UTV.
Hello and a very warm welcome to a fresh episode of Smart Money. We've got a pretty packed show this time around as well. Investment ideas coming your way, and we're beginning with some stock picks for you. PSU banking space, that has been a buzz. Here are some stocks you could consider.
Bank of Baroda, it has came out with an excellent Q2 FY10 number and a healthy set of first half year FY10. The bank has also reiterated the fact that it would continue to give a stellar performance in the second half of FY10. We have revised our earning estimate on the upward direction with a net profit increment of 6.5%. I think in the current market price, it's an excellent buy with a price target of rupees 589. Max India. Max India gives you an exposure into two of the rising sector, which is insurance and healthcare. It has a market capitalization of 5.2% in the insurance sector and a healthy margin of 21.2% at the NBAP level. What we see in the near term is a trigger into the FDI limit hike by the government in the insurance sector. And second thing is, as the private insurance are going to be listed on the bourses, which would provide a near term trigger for the stock. We have a price target of rupees 295 for the stock. Dhampur Sugar. It is India's fifth largest in terms of sugar cane with a capacity of 39,500 TCD. We see an average realization at the PBIT level somewhere around 5 to 6 rupees per kg, which would help the company to triple its profit in FY10. Our estimation is around 160 crores. We see a handsome gain if you are invested for next 2 years in the stock.
Now, those are some stocks that you could consider, but now let me introduce you to the two gentlemen sitting with me. Vijay Mirani, of course, is 25 years old. He's in the real estate business, started very young, at 19 years, and now he's got his goals charted out. You're looking at getting married in the next 2 years.
Absolutely.
You want a house by then, and also you want to lay out your retirement plan.
Absolutely.
So that's on the agenda, and to be able to do this exactly, we'll need Sumit Ved to come in. He's a CFP. Let's just understand what you bring to the table first, Vijay. From what I'm seeing over here, you have an income of 29 lakh rupees every year. Besides that, your expenses amount to 9 lakh. You have cash in hand of 3 lakh rupees. You've also invested in fixed deposits, 7 lakh rupees, in post office savings schemes, 2,70,000 rupees. He's also got investments in real estate. Those amount to 2 crores 25 lakh rupees. And he has investments in jewelry as well to the tune of roughly 3 lakh rupees. So that's how his portfolio is looking, Sumit. What do you say at the outset?
Now, if you see Vijay's plan, his three goals primarily, which is buying a house by 2011, marriage for self, 2011, and taking care of retirement. The advice to him is for 2011 house, which he's planned to buy for worth 75 lakhs, he should go in for a housing loan of 40 lakh rupees and plan regular savings through systematic investment of rest 35 lakh rupees. So our advice to him is for house, he should start a systematic investment plan of 96,000 rupees a month, which is split in the ratio of 20% equity, 80% debt, and do it regularly for next 2 years,
yes,
which will help him achieve the goal of accumulating the down payment, which will help him buy the dream house.
But this is interesting because while I was looking at your portfolio, I realized that you have no exposure to equity so far. You've always gone with safe investment bets like fixed deposits and post office savings scheme. For someone that young, I'm surprised that you're not taking any risk with your investments with the kind of income that you have.
I initiated my investments in mutual funds, but because of the market scenario and stuff, I lost some amount of money in that.
Right, so you burned your fingers there.
Yeah. So my first experience in mutual funds wasn't that great. So maybe I just thought that, safe and sound investment is the way to go.
So you put in significant amount of your money in real estate. Is that a good idea, Sumit?
I think Vijay needs somebody like me to help him out and plan better. My advice to Vijay will be that not to ignore equity, especially looking at his age and looking at his goals. Past experience not necessarily really repeats itself. That should not stop him taking exposure into equity.
That's right. So which is exactly what he's suggesting. You need to start an SIP of what amount did you suggest?
96,000 rupees.
96,000.
That's right.
This is a yearly...
no, this is a monthly SIP.
Oh, right. Of course, considering the income.
Yeah.
We are looking
and also
at
considering the goal,
And the goal is exactly very,
it's about
very
a couple
close.
of years.
It's 2 years from now.
Yes?
That's right.
So are you open to that, putting in money through the SIP route?
Yeah, I'm partially open to SIPs. Also, I want to know the other form of that direct investment in equities. Is it a good option?
Definitely, it is a good idea, but keeping your investment horizon in mind, which is 2 years in this case, that's not advisable, because usually direct equity should have a play of more than 3 to 5 years for the businesses which you are buying to really show you the performance. So for your retirement goal, I think you can look.
Right.
Not for housing.
Right.
Now, retirement planning has to be equity based, or it can be a different form of investment.
See, that's an interesting point, because if you look at Vijay's age, he's got close to 20 odd years to really go for retirement, and that's a very healthy amount of time which he's got with him, and the benefit of starting early. And if you look at his retirement goal and working on his expenses which he requires, he needs to accumulate something like 7.5 crore rupees.
Wow.
In next 20 years. Now, first things first, you'll not be able to accumulate that without getting into equity. So equity as an asset class gives you long-term decent returns over a period of time, which most of the other asset classes do not. Historically, that's how it's gone. So keeping that in mind, we are advising Vijay, in order to save for retirement, save a systematic investment plan every month of 25,500, split in equity and debt funds in ratio of 70% equity, 20% in debt fund, and 10% in gold.
Right. Does that sound like a good plan for you?
Sounds like a good plan, especially if I save 7.5 crores at my retirement.
Is that going to be enough?
Keeping the
going, with the inflation trends that we are seeing right now, Sumit, is that going to be enough for him to keep his lifestyle going, the one that he currently has?
Plus the changing patterns once I get married, my living, and all those, keeping all those things in mind, maybe that's going to help.
Sure. See, financial planning is a very dynamic exercise. It's not static. As of this year's assumption, the way it looks like it's going to be enough.
Sure.
But when your wife comes, she starts spending money, I think we need to sit again and analyze. It might be 15 crores you might need at the time of retirement.
That's right. So you need to keep revisiting your plan and being able to see whether you're still on track, because retirement is quite a few years away. You've got quite a few years to track before you hit retirement years, and before that, of course, like your house as well as your marriage, those are the things that you need to take care of. So that's the immediate goal. For that, we are set as of now.
Very much.
So we are thankful to you to be able to get to this point where we are set as far as immediate goals are concerned, and we'll keep tracking it, keep coming back to you and seeing exactly how the plans are going. Thanks very much, Vijay, for joining us on the show as well.
Thank you. Thank you.
And of course, we'll take a small break on that note. If you have a portfolio that you'd like us and our experts to take a look at, tell us about it. smartmoney@utvnet.com is our email ID. You can also SMS us. The number for that is 59995. Right now, a very small break, and as we do, we are busting an investment myth for you, as we do always, and we'll be back with more tips on investments on the flip side. Stay with us.
Historically, it has been seen that real estate over a period of time gives you a very stable return. But there is no efficient price finding mechanism which we can use here to quote that real estate has given so much of return. These are all claims which people do. These are all gut feel experiences which people have. So it becomes very difficult to predict the kind of return which you should expect out of real estate. But having said that, there is a interesting correlation from an asset allocation point of view between equity, debt and real estate, which kind of stabilizes the returns of portfolio. Hence, real estate is good in any portfolio, but in a proper manner.